All right, so learning objective 3 simply introduces you to generally accepted accounting principles, what we call GAAP. Um, these are that set of rules and practices that financial accountants have put together so we can have some standards in how we report financial information. Okay. And so that's why the income statement has certain structure. That's why the balance sheet has certain structure, is because everyone has to follow those structures regardless of what company you are working for or what industry you are in. Um, and because they're all reported the same way. The rules that tell us about all that is what we call GAAP. You have to know that. You have to know the definition. What you might not know is how GAAP is actually created. You know, who sets these rules? A lot of people just automatically assume, oh, the government set the rules. No, actually, this is very interesting. Um, the rules are set basically. The most important figures are the actual accountants themselves, the actual CPAs that actually create the financial accounting standards boards. These are the folks that first and foremost sit down and make up the rules. Now, because these are financial reports and corporations are required, if they're a public corporation, meaning they have stock that you and I can buy, because they're required to report this publicly to the government, the SEC, which is in charge of regulating all the stock markets and other markets like that, they have a say into how the financial reporting should be done as well. But for the most part, GAAP is created by the accounting profession in consultation with accountants and lawyers at the SEC. Okay, so it's really quite interesting how it's all done. GAAP is simply a US thing. The United States almost stands alone in using financial reporting standards called GAAP. The rest of the world, as the note down here shows, the rest of the world basically uses something called IFRS, the International Financial Reporting Standards. And we have been working to merge those systems. They agree in some areas and they disagree on other areas. But almost all the other countries of the world use IFRS. The U.S. Basically stands almost solo with its use of generally accepted accounting principles. So as the Financial Accounting Standards Boards, those accountants that put together GAAP, it's the International Accounting Standards Boards, this another group of accountants that puts together the rules called IFRS for international accounting. So that's what you have to know about this. That's important. Some other types of things to know that are that help you understand why accounting is the way it is. Because accounting is dealing with information, we have to make sure that the information is relevant, right? Means it makes a difference in the decisions of a business. And it is represented faithfully, which means it's accurately presented. Okay, so these are two, perhaps what they call fundamental qualities of all accounting information. If it's going to be useful information, it has to be relevant and it has to be faithfully represented, which means it's got to be free from error, all right, reported without bias. Of course, there is also some other type of enhancing qualities that guide all of this stuff. Results have to be comparable. So we're all using the same basic forms, right? The same accounting principles. That's why GAAP is so important. Everybody uses it so we can compare everything. The information can be verifiable. So you're not just putting numbers down on a piece of paper. You actually have records and other types of things that prove the information is verifiable to an independent observer, which we would call an auditor, right? Someone else can come in, look around and say, oh yeah, I know how they got to this. Certainly, it has to be understandable, and we have to use the same methods year to year. And of course, everything has to be reported on a timely basis, right? Monthly, quarterly, yearly, things have to be reported. A couple of other things that we assume in a lot of financial reports is we're all using the same money. We're all using the same currency. If it's a US company, they have to use US dollars, even if, because a lot of companies are big and they're global. So when they're selling products in Japan, they're not selling them for US dollars. They're selling them for Japanese yen. So this monetary unit assumption means that when we're actually looking at the financial reports, they've converted all that to US dollars. Okay. We also have to make sure that the entities are being separately identified. So this often happens with, for example, if you had a business, you are separately identifying accounting records for your personal home and your personal business. So it's sort of a economic entity. Make sure you are separating those records so we're actually seeing what's happening in that particular business, and nothing is commingled with anything personal or otherwise. One assumption that you're going to be learning a lot about in chapters 3 and 4 is the periodicity assumption. And that means that the life of a business is going to be divided into the same artificial time periods. We measure things monthly, we measure things quarterly, which is a 3-month period, and we measure things yearly. We never measure things over that year period. So the shortest period is a month, the longest period is a year, and that's important for measuring. That's periodicity assumption. We also assuming in the case of corporations, it's a going concern, which means the business is going to be operating for the foreseeable future. Henry Ford has been pushing up daisies for a long time. He's been long dead, but Ford Motor Company still exists. Walt Disney, whether he's dead, on ice, frozen, whatever, other Disney type of jokes you want to throw at that. He's long gone. I don't think he would recognize Disney if he did come back, or he was, how do you unfreeze him? Put him in the microwave? He wouldn't recognize his own company, because Disney is so much bigger than what he had envisioned, right? So it's a going concern. It's going to be going into the foreseeable future. We're going to keep assuming that it's never going to end. Okay. When you see assets there's some principles of generally accepted accounting principles. One thing is when you see assets on the balance sheet, the asset is going to be listed on what they paid for, not what it's worth today. So if they bought a building back in 1921 for $1 million, the building is going to be on the balance sheet for $1 million. That's the historical cost principle. Even though that building might be worth $100 million today, we don't care. In accounting, we measure things based on what we actually paid for them. Okay. We also have to keep track to make sure that we're never overvaluing anything on our balance sheet. And so we have to keep in mind that what we want to represent to everybody in our financial reports is our assets and liabilities are at fair value. Okay, at fair value. We also need to disclose various things that make a difference, a financial difference to the company. And that's really what full disclosure is about. But when we do full disclosure, we also have to make sure that the information we're providing doesn't cost the company more than it benefits them. So we do have to list the fact that we might be being sued by our employees for back wages, and it looks like we're going to be losing that particular court battle. Well, I mean, it's not over till it's over. I mean, go back to Yogi Berra, that's true with court. It's not over till it's over. So disclosing certain information might actually hurt the company more than benefit, even though it's not happening yet, right? So it's important to make sure that we put that cost constraint into effect to make sure that when we do disclose, it's actually relevant, it's actually real. And so then it comes down to do it exercise 3, which basically is a laundry list of making sure you know how to identify all those little things that we just mentioned. And that is learning objective 3. Questions?